Hi there, you're watching Market Cafe with me, Shreyanshi Singh and Snehi Shah on ET Now. And over the next 1 hour, we'll take you through news and updates from within the country as well as across the globe, tell you which stocks you should keep on your radar and tell you what the brokerages are saying as well. But Snehi, first up, let's get started by looking at the international handover, and what a handover it's been, right?
Well, absolutely, and a good week coming in from the global markets as well. Hi there, good morning, and let's take a look at how the global markets have shaped up. Let's start by looking at the moves coming in from the US, and well, stock futures are little changed following S&P 100's best week since November. So very good moves coming in on that index as well. Dow Jones has ended Friday with an uptick of 0.4%. S&P 500 is up 1%. Very close to that 5,100 mark. It's closed at 5,099.96, so very close to 5,100 as well. Nasdaq on the other side has outperformed both of its peers. Very stellar moves coming in from Nasdaq. That index was also up 2% on Friday, and very good week overall coming in for the US markets last week, and traders are also going to look ahead the week with more corporate earnings, key labor data, and the very important FOMC meeting that will be starting tomorrow, and we'll have the rate decision day after tomorrow. So in India parlance, we'll have the decision somewhere around Thursday, but well, yes, the FOMC rate decision is also going to, that meeting is going to kick off tomorrow as well. Now, these moves have followed a rather positive market, and things are looking good on Wall Street as of now. The S&P 500 has jumped 2.7%, which is the best week since November and breaking its 3-week negative streak. So that index on a weekly basis has managed to turn positive. And how, right? Because it's breaking all its levels. It's breaking its levels in the past as well. Now, with a rally of 4.2%, Nasdaq has also seen a very good week overall last week. This is a weekly move that's coming in for the Nasdaq. Also saw its best weekly performance going back to November and its first winning week in the last 5. S&P 500 has broken its 3-week losing streak. Nasdaq on the other side has broken a 5-week losing streak as well. And Dow also has not done rather bad for itself. It has finished the week with an uptick of 0.7%. But yes, it has underperformed both of its peers as well. Now, earnings seasons continues this week for the US. Releases from major names like McDonald's, Coca-Cola, Apple, Amazon is also going to happen this week, and it's shaping up to be a strong quarter. And of the more than 45% S&P 500 listed companies that have posted their results so far, about 4 out of every 5 of these have surpassed expectations. So earnings are also looking very healthy when you look at Wall Street, and majorly this is what is keeping Wall Street afloat, or rather keeping it higher in the positive as we speak. Now, monetary policy will also take the center stage in the week. Fed is set to release its latest interest rate announcement, and central bank is widely anticipated to keep the borrowing cost unchanged. Investors will still monitor for any key commentary that Jerome Powell has to give when he talks about the commentary after the rate decision is out. And this announcement comes ahead of April's non-farm payroll data that is expected on Friday as well. And traders will be analyzing this data for insights of the strength of the labor market. So largely, these are the moves coming in from the American markets. Wall Street looking rather good. On the other hand, Europe is also looking very good to me as of now, because DAX has closed on Friday with an uptick of 1.3%. FTSE also looking close, almost 1% uptick coming in over there as well. And the Pan-European Stock 600 index, that has also closed last week with an uptick of 1.1%. So very comfortably in the green all of these indices are, if I could say that. And good moves coming in across Europe as well as US. So good global support coming in this week. So we'll see how our Indian market pans out from that and how our moves shape up as well. But Shreyanshi, take us through what's happening in the world of oil, because lots of action happening there as well.
Absolutely, and it's very interesting what we're seeing play out in the oil prices now, because you see that geopolitical risk premiums sort of make a comeback right now. So, when you look at oil prices on Friday, what you're looking at is that oil basically just snapped a 2-week losing streak, drawing support from concerns about tensions in the Middle East. Like I mentioned, that geopolitical risk premium making a comeback. Now, when you look at US WTI, you're looking at gains coming in of 28 cents of about 0.3%. And prices settle around that $83 a barrel mark. Now, when you look at Brent as well, you're looking at gains of 49 cents or about 0.5% thereabout, and prices settle around that $89 a barrel mark. Now, US crude oil rose 0.8% for the week, while the global benchmark, when you look at it, that gained 2.5% as well. US Treasury Secretary Janet Yellen said that US GDP growth for the first quarter could be revised higher and inflation will ease after a clutch of peculiar factors held the economy to its weakest showing in nearly 2 years. Now, US economic growth was likely stronger than suggested by the weaker quarterly data, is what she also said, and oil prices have flip-flopped since her comments as well as the release of the inflation data on Friday. So, the personal consumption expenditures price index increased 0.3% last month. And in the 12 months through March, US inflation also rose 2.7% after an advance of 2.5% in February. Last month's increase was, of course, broadly in line with economists' expectations as well. And another thing that you're seeing play out is that supply concerns also supported prices as tensions continue in the Middle East. So the geopolitical risk premium is making a comeback for oil, but you can't say the same about gold because gold prices held gains on Friday, and that was after data showed that US inflation rose in line with expectations, like I mentioned. But the safe haven metal was also on track for that weekly fall because the geopolitical risk premium for gold has eased. So these are the trends that we're seeing play out in the oil and gold market.
Well, absolutely. And with that, let's also take a look at all the important cues that we need to be watching out for this week. From the Eurozone, you have economic confidence as well as consumer confidence data that is expected. Now let's shift focus back home, talk about some important earnings that are lined up. And today from the Nifty 50 pack, you have Ultratech Cement coming out with its numbers today. And from the non-Nifty pack also, you have the likes of Trent, Poonawalla FinCorp, KPIT Tech, KFinTech, PNB Housing, Fedbank Financial, Birlasoft, UCO Bank, Indostar Capital, Canfin Homes. A lot of earnings coming out today from the non-Nifty pack as well. Over the course of the week, then 2nd May from the Nifty pack, you have Coal India as well as Adani Ports, and the 3rd of May you have Titan as well that will be coming out with its numbers. Now shifting focus, let's also talk about some corporate action then. For today, in terms of corporate action, you have Jyoti Structures that will be in Jyoti Structures right issue is closing today, so that stock will be in focus. And lock-in period is also ending for Nova Agritech today. 6% equity is coming out of lock-in period as well. In terms of other news, you have China that will largely be in focus today because all 4 Chinese mega banks are going to be reporting their Q1 earnings today. This will largely give us an insight to how China's financials are shaping up right now and how that space is looking like. So important numbers coming in from China as well in terms of banking earnings. And on another note, Japan markets are closed today on account of a public holiday. So well, these are all the important cues that you need to be watching out for in today's trading session.
Well, absolutely, and there's a lot of important stories that you should also be looking at and important commentary as well. So first up, Borje Brende, president of the World Economic Forum, gave a stark outlook for the global economy, saying that the world faces a decade of low growth if the right economic measures are not applied. Speaking at WEF's special meeting on global collaboration, growth and energy for development in Riyadh, Saudi Arabia, he warned that the global debt ratios are close to levels not seen since the 1820s, and there was a stagflation risk for advanced economies. So that's the commentary coming in from the president of the World Economic Forum.
Well, alright, let's get a move on then. And Chinese President Xi Jinping told visiting US Secretary of State Antony Blinken that Washington needs to look at China's development in positive light in order for bilateral relations to improve. The Chinese leader's comments come as the US has imposed restrictions on Beijing's ability to access high-end tech and is moving close to banning social media app TikTok unless its Chinese parent ByteDance sells it.
Meanwhile, Tesla top boss Elon Musk makes an unannounced visit to China. According to reports, Musk met the Chinese Premier Li Qiang in Beijing, during which they discussed the company's development in China and setting the stage for stable US-China relations. Among other issues that topped the agenda for this meet was the full self-driving software and permission to transfer data overseas. Just earlier this month, mind you, Musk said that Tesla may make FSD available to customers in China very soon.
Well, shifting focus then, now amid the scorching summer heat, India's apparel industry is poised for a resurgence. CRISIL predicts a robust expansion fueled by domestic demand and export recovery. With a projected revenue of $105.5 billion in 2024, the sector is set to grow by 3.8% annually for the next 4 years. My colleague Bhavya Dua filed in this special report with all of those details. Listen in.
Despite the scorching summer waves sweeping the country, there's one industry poised to remain cool: the apparel segment. Rating agency Crude has predicted a resurgence in textiles industry during the calendar year 2024, buoyed by sustained growth in domestic demand, gradual recovery in exports, and reduced cotton prices playing key roles in driving this expansion.
I think the March and April have been good months. So I think the summer started up well, and hopefully this will continue for the next few months and seasons to come.
According to data insights platform Statista, Indian apparel segment is estimated to be a $105.5 billion market in terms of revenue in 2024. Now, despite a downtrend witnessed in the last few months of 2023, the industry is expected to grow annually by 3.81% for the next 4 years. The brands are even expecting a growing demand this summer.
2024, we are seeing a lot of sustainable fashion. You're seeing a lot of cottons. People want to get back to their roots. So a lot of brands are focused on a pure cotton collection.
Consumer trends and preferences in India, particularly among millennials and Gen Zs, are undergoing significant changes. Customers are becoming increasingly informed thanks to the digital penetration, which has also made them more discerning and particular about their fashion choices.
Data is very, very high here. We are one of the most affordable markets in terms of data and smartphones, right? And I think the young population of this country are all sitting digitally. So I think they consume a lot more data, a lot more information than others consume across the world. And I think that allows them to get an influence for sure. Now, I can be influenced for trend, I can be influenced for style, I can be also influenced of how global things are happening. And I think that is the biggest challenge for brands, that we have to be at our toes.
The time from mill to our store, how long does it take from our fashion hubs, the manufacturing hubs of Surat, Banaras, Calcutta, Bangalore, and how, even Delhi for that matter, Jaipur, and how quickly we can get those styles or those inspired looks, celebrity-inspired looks, or the trending looks at our store. I think that is one of the key areas of my focus.
The textiles and apparel industry is the second largest employer in the country. As per Invest India's data, it employs around 150 million people both directly as well as indirectly. And a boost in this segment and a rebound in this segment is surely going to boost the Indian economy.
Alright, time for a quick break then, but when we come back, we'll take a look at how the Asian markets are faring, so you don't go anywhere. Welcome back. Thank you so much for staying tuned in. Well, as promised, let's take a look at the Asian markets then. And Asia Pacific markets climbed as traders look toward the Federal Reserve's meeting this week following another hotter than expected US inflation reading on Friday. Now, in Asia, of course, China's official Purchasing Managers Index for April is expected on Tuesday ahead of the Labor Day holiday on Wednesday. And that will remain in focus along with Japan's industrial production and retail sales data from March. But let's take a look at what indices are doing then. Nikkei, of course, is closed. Japan's markets are closed for a public holiday. But let's take a look at what ASX 200 is doing right now. And it is in the green right now, up about 0.4%. When you look at Kospi as well, good moves coming in for Kospi, up about 0.8% thereabout in trade. And when you look at Hang Seng then, that is also in the green. On your screens, up about 0.5%. Shanghai though is on the back foot. So that is about 0.1% of a downtick coming in for Shanghai. But when you look at what happened back home we closed around the 22,419 mark. And what you're seeing, the Nifty implied indicate is a solid, good start coming in. A gap up open is what is being penciled in based on the Nifty implied, both on a spot and futures basis. And that is the kind of handover that we're getting. And after the strong handover that you got from Wall Street, of course, this is no doubts for guessing that, we're penciling this in. But looks like it's going to be a good day for us in trade.
Well, absolutely, and not good, Shreyanshi. Hi there, welcome back, and thanks so much for still staying tuned to Market Cafe. You're watching ET now. Let's take a look at earnings that have come over the course of the weekend. And tech major HCL Tech has delivered a lukewarm set of Q4 numbers, a miss on all counts. Let's go across to my colleague Anisha for the earnings fine print of HCL Tech. Anisha, good morning. Take it away.
Came in line with expectations broadly because there was a a growth of 0.3% on revenue basis on a quarter-on-quarter. But overall, there was a bit of a miss on the margin front because we were expecting margins to be 18.7%. It actually delivered a margin of around 17.6, 17.7 thereabouts. And that led to the miss on the profitability as well. But the bad news doesn't end there. There is that guidance which has been very weak by the company. So they've guided for a growth profile of 3 to 5% in the coming year. There were parts of the street that were expecting growth to the tune of 5 to 7%. There were even analysts on the street expecting a 6 to 8% kind of guidance for FY25. It's come in much lower than expectations. And even on EBITDA margin guidance, there's a bit of a miss because for the last couple of years, company has been guiding for this 18 to 19% band. There hasn't been any improvement. This year as well, they continue to maintain the same rate when it comes to the EBITDA margins as well. Having said that, a bit of a silver lining is in terms of the deal wins, which are steady at $2.3 billion. The other disappointing bit is in the management commentary. They point out how FY25 is going to be a challenging year. Now, while companies like TCS and even Tech Mahindra have said that FY25 is going to be better than FY24, HCL Tech says FY25 is going to be at a similar level than FY24. They also talk about how there's going to be higher than usual seasonality in Q1, which means we should brace ourselves for a weaker Q1 as well. So my estimate is that the stock will take this negatively come Monday morning because it's a miss on all parameters, whether you look at Q4 as well as the FY25 guidance.
The revenue guidance, we continue to remain quite optimistic about the opportunities ahead of us. From Q4 to as we get into FY25, some of the large deals that we won will move into a global delivery model, and that will have some reduction in revenue. Apart from that, we believe still we have a strong momentum in a lot of areas. Now, when all of that is also factored in, with the macro environment, our assumption is will continue to be similar to what we saw in FY24. So factoring all that, we have given a guidance of 3 to 5%.
Question is really seasonality in one word. As you know, our software business has a peak in the December quarter, and that is how we were kind of near 20%. And our guidance for the new year FY25 continues to be at the same 18 to 19% band that we had for the previous 2 years.
All right, then that's the word coming in from the management, but let's also take a look at what the brokerages are flagging out as well. When you take a look at what Nomura is saying, they're maintaining a neutral rating, but they're cutting the target price to 1,400 rupees, so 1,400 from the 1,500 target earlier. So now when you look at FY25 guidance, what they're saying is that that is weaker than expected. They're also saying that FY25 to 26 EPS estimates cut by about 5% due to lower revenue and margin assumptions. So that's the word coming in from Nomura. But when you look at what Investec is saying as well, they're maintaining a sell rating with a target price at 1,300. They're also saying that the company had some of the best large deals in financial year 24, but that's not easily replicable in their view going ahead. And what they're also saying about the revenue guidance is that they're seeing it weaker than the expectation. In fact, in terms of the EPS estimates, they're also cutting the financial year 25-26 EPS estimates by 2.2% to 2.4%. So that's the word coming in from Investec as well. So this is largely what brokerages had to say about HCL Tech as well.
Well, absolutely. And let's shift focus from one earnings to another. Let's talk about ICICI Bank, because that private lender has delivered largely in-line set of numbers for Q4, wherein the profit after tax was up 17.5% on a year-on-year basis. Let's break down the performance and bring in my colleague Gaurav to get a fine print of these numbers and what the management said over the earnings con call as well. Good morning, Gaurav. Take it on.
Well, yes. Talking about ICICI Bank, this bank registered yet another strong quarter, we could say, because if you look at the performance, it was actually in line or rather above the street's expectations. So, for example, if we talk about interest income, it was up almost by 22.3%, while net interest income was up 8.1%, and PPOP was up almost by 8.8%. Now, we saw some operating expenses going up only by 9% on a year-on-year basis, and that was the reason why PPOP was up almost by 8.8%. Apart from that, if you look at PAT, it was up almost by 17.4%. 4%, which was actually above the street's expectation. And this was because of the provisions that we saw decline both sequentially and also on a year-on-year basis. Apart from that, if you look at GNPAs and NNPAs, we also saw some improvement happening over there. So for example, GNPAs improved almost by 14 basis points on a sequential basis, while net NPAs improved by 2 basis points on a sequential basis, and now it stands somewhere near 0.42%. Now let's come to advances and deposits. This bank reported yet another quarter of strong growth in advances as well as deposits. So advances grew almost by 16.2%, and now it stands at 11.84 lakh crore rupees, while deposits grew almost by 19.5%, and now it stands somewhere near 14.12 lakh crore rupees. Apart from that, if you look at some of the other metrics also, net interest margin, that remained at 4.4% versus what it was at 4.43%. It declined by 3 bips, but again it was in line with what the street was expecting. And lastly, if we talk about CASA ratio on a daily basis, bank reported CASA ratio of 38.9% versus 39.4% on a quarter-on-quarter basis, which was again healthy for the bank and in line with what the street was expecting. Apart from that, if we look at management's commentary, they are again being positive on the bank's growth, and at the same time they expect net interest margin to remain range bound, because we may not see rate cuts happening in at least in first half of FY25, sorry. And lastly, they are also being very optimistic and very cautious about the IT outrage that happened. They have said that they are in touch with RBI and the regulators to resolve the issue, and definitely the IT issues at their utmost priority. So all in all, positive commentary coming up from management as well, and we have already seen that bank has delivered a healthy set of numbers. So definitely watching out for this bank, because this bank has not disappointed the investors even in this quarter.
We will continue to grow our liability franchise in healthy ways and optimize both the quantum and cost as a starting point, and then price our lending opportunities in an appropriate way. As we are aware, we have been talking about trying to deliver a 360 system from an overall customer point of view. We do expect NIM should be range bound, adjusted for seasonality of course, unless there is any change in repo ratio. As there are imponderables during the year, which we are not really aware of. As we have mentioned, repricing of term deposits will continue even in Q1 of 2025. Going ahead, we do expect RBI to undertake a shallow rate cut, and we will see how this goes along during the course of the year. So IT resilience and customer security is of paramount importance to us, and this is not constrained by any budget. Having said that, this is an ongoing effort, and there could be instances of outages and errors in any bank. We have an ability to take quick recovery and corrective actions, and we will remain focused on improving our capabilities in this area. As regarding discussions with the regulator, this is an ongoing discussion on every aspect which we have, and we remain focused on complying with the regulatory guidelines which RBI gives us from time to time.
All right, then that's the word coming in from the management, but let's also take a look at what brokerages are saying, and what Nomura is highlighting is that they're maintaining a buy on the counter, but they're also hiking the target price to 1,335 from 1,225. In fact, about the fourth quarter, they're saying that it was another robust quarter. They're seeing strong deposit growth as well and robust operational performance coming in for ICICI Bank. What they're also highlighting is that operating leverages are seen emerging, according to Nomura, on ICICI Bank. And when you look at what else they've said, they've also talked about how there's a build sector leading 18% loan growth and ROE over financial year 25 to 26. So that largely is the word coming in from Nomura on ICICI Bank.
All right, let's keep it going with the earnings coming from banks. And then while that was ICICI Bank, let's move on and talk about what Yes Bank looked like, because Yes Bank also reported its Q4 numbers over the weekend. The profit jumped on a year-on-year basis, while the asset quality has also improved. Gaurav is back with us for more details on that. Gaurav, hi, good morning. Once again, thanks for joining us, and take us through what Yes Bank's numbers look like.
I've already seen that this bank actually delivered strong set of numbers when it comes to profit after tax. So for example, let's look at all the other numbers as well. So net interest income increased almost by 2.3% on a YY basis. PPOP increased almost by 1.5%. And if we look at the profit after tax, that increased almost by 123%. Now it stands at 452 crores versus what it was at 202 crores on a YY basis. And this was because of the lower provisions that the bank had given, and at the same time we also saw some tax benefit coming up with the bank. Apart from that, if you look at some of the asset quality aspects, gross NPAs and net NPAs also improved almost at 30 basis points. So now gross NPA stands at 1.7% and net NPA stands at 0.6%. And coming again back to the provisions, we have already seen that the provisions were down almost by 15.1% on a YY basis. Apart from that, if you look at banks ROA, which is return on asset, that improved to 0.5% versus what we have seen at 0.2% in the last quarter. And at the same time, if you look at assets growth, the total assets grew almost by 14.3% on a YY basis, while deposits saw a growth of 22.5%, which was again strong for the bank. So all in all, good set of numbers are reported by Yes Bank as well, and definitely on the back of profit after tax, which has increased almost 123%. We will keep an eye on Yes Bank because that seems to be a positive trigger for Yes Bank in the last few quarters.
Absolutely, we'll definitely be watching out for the reaction on Yes Bank. But of course, Maruti Suzuki also reported its numbers, and when you look at the automakers' numbers, decent set of numbers coming in. When you look at the revenue, that was in line, EBITDA as well as margins were in line with estimates. Now, revenue crossed the 38,000 crore mark, and when you look at net income, then that surpassed estimates to rise above 3.8 thousand crore. When you look at margins also, margins expanded for the quarter on a year-on-year basis. So the margins came in at 12.2% versus 10.4%. When you look at what else they've talked about, they announced the highest ever dividend of 125 rupees per share, and net profit of course was higher on account of higher sales volume as well as favorable commodity prices. So that largely was the roundup coming in when you look at the Q4 for Maruti then. But let's also listen in to what the management had to say then about their numbers.
I am optimistic on the outlook for 24-25. I believe that a new government will come into power in the next couple of months, less than that now actually, that the new government will have a very good base from which to go forward. And I think in the beginning of the year, one should see several measures taken by the new government, which will propel the economy and industry forward at a much faster pace than in the past. So if that happens, and I think there's a good chance that will happen, I think the car industry should also look forward to a year which is pretty good in all respects.
Alright, that's the word coming in from the management of Maruti, but let's take a look at the numbers that came on Friday then. And newly minted Nifty 50 company Shriram Finance came out with its quarter four numbers. Let's take a look at what the numbers look like. And well, largely inline set of numbers coming in across NII, PAT as well as operating profit. But estimated and compared to ET Now poll, NII is a slight bit of a beat when you compare it with our internal poll. Let's take a look at what the numbers look like. Net interest income has come in at 5,336 crores. Versus 4,446 crores, which is an uptick of 20% on a year-on-year basis. Operating profit has come in at 3,906 crores, which is also up roughly 10% on a year-on-year basis as well. Net profit has come in at 1,946 crores versus 1,300 crores, and this is a very good move coming in over here because this is up by almost 49% when you compare it on a year-on-year basis. When you take a look at the NIMS growth, when you compare it on a sequential basis, slight bit of an improvement coming over there, but not much, rather stable. Return on assets and return on equity also doing pretty well for themselves. Return on asset has expanded on a year-on-year basis, and return on equity also looking very healthy as of now at 16.4% versus 12.2% on a year-on-year basis. AUM growth has also been healthy, 21% uptick on a year-on-year basis coming in on that front as well. Asset quality has remained largely stable with gross and net stage 3 being largely stable and where they were. Board has approved a dividend of 15 rupees per share as well. And even when you shift focus and talk about their housing finance business, those numbers are also looking healthy. AUM growth has been robust at 13,761 crores versus 8,047 crores on a year-on-year basis. Net interest income is up by 44%. PAT is also up by 67% as well. But even when you take a look at what the management had to say, a good commentary coming in on that front as well. They're confident of maintaining NIMs at 9%. Focus going ahead will be on higher yielding assets as well. They see lower quarter one growth. This is a slight bit of pain point coming in over here because they see lower quarter one growth in FY25 on the back of a cut down in capex, which is going to happen on the back of the elections taking place. And focus going ahead will be on growing bottom line faster than the top line. This is largely what the management also had to say. But also let's take a look at what brokerages had to say. And first, let's take a look at what Goldman Sachs has to say on the quarter four numbers. They've maintained a buy rating but have gone ahead and raised the target price to 2,864 rupees from 2,797. They believe that the strong show is looking good with visibility ahead, and increased conviction on outlook is what Goldman Sachs' stance is when it comes to Shriram Finance. On the other side, Jefferies has also come out with a note. Again, maintain their buy rating, also have gone ahead and raised their target price to 2,950 rupees from 2,740. They believe that steady growth at reasonable valuations is what lies ahead for this company. Loan mix changes to keep NIMs range bound. So this is a slight bit of a pressure point that they're seeing coming in, but they are also seeing 17% earnings per share CAGR and 16% adjusted return on equity over FY24 to FY27. And also Shriram Finance is among their top picks when it comes to the NBFC basket. So good brokerage notes coming in on Shriram Finance as well. Overall, good set of numbers coming in. Good quarter for Shriram Finance this time around.
Alright then, time for a quick break then. But when we come back, we'll take a look at some more stock specific news, so you don't go anywhere.
Hi there, welcome back and thanks so much for staying tuned to Market Cafe. Now we're getting more updates about the fraud that M&M Finance had reported last week. Remember, on the back of that, they've had to push their earnings as well. 23rd April is when the earnings were slated, and now they've been pushed all the way to the end of the earnings season at 30th May. But now we're getting more details about this fraud. And this update has been coming in from Mizoram Police over the course of the weekend. And they say that the area manager of that branch has been the mastermind behind this entire scam. His name is Jafir Hussain, and he has made all of these fraud accounts, and we'll take you through more details of that as well. And the area manager sanctioned vehicle loans by creating fake files for over 2,000 customers. He opened a fake bank account that resembled the name Mahindra, and this account was established all the way back in 2020, which means this fraud has been taking place right under M&M Finance's nose over the course of the last 3 years, a better part of 3 years as well. And he submitted forged documents to open this account. This bank account has been used to hold defrauded money over the last 3 years, and the area manager has also involved a few local car dealers into this controversy that he has created. Let's understand how this was done. And the area manager and his associates regularly made EMI payments to this fake for the loans from the fake bank account, so that these loans did not turn into NPA and did not cause any suspicion. He prepared forged stamps, he hired an assistant, and every time there was a company audit, he transported all of these fake files to his assistant's house. Now, in terms of what the police have recovered so far, they've recovered 7 sacks that contain 549 stamps with 549 files with 25 false stamps from the assistant's house. Total recovery so far has been of 13 crore, which if we assume that the scam is to the extent of 150 crore, this is only 9% of what has been recovered so far. Car dealers have returned 3.5 crores to M&M Finance as well. And the arrests have been made. This person who has created this entire scam, Jafir Hussain, he has also been arrested. His associates have also been arrested so far, and further investigation is also taking place. So, well, that's the latest update coming in on the fraud that has taken place at M&M Finance's Northeast branch.
Well, absolutely, and a lot more to be uncovered then, because this is just 9% of the assumed embezzlement amount that we have. But we also have Gaurav joining in with the brokerages. We've of course taken you through some of them. But Gaurav, which are the other ones that you're keeping on your radar then?
Well, yes. First, let's talk about BSE, because this stock has seen a decent run up, but now Jefferies has downgraded the rating to hold, and at the same time they have cut the target price to 2,900 rupees per share. What they believe is that recently we have seen that the regulatory fees has been hiked, and because of this SEBI's order, this can impact the EPS almost by 15 to 18%, and at the same time price hike can actually offset 2/3 of the impact immediately, and that is why they are being a little bearish on BSE. At the same time, let's also talk about Indigo, because now Morgan Stanley has maintained its overweight rating and hiked the target price to 4,615 rupees per share. What they believe is that Indigo has both a large and sustainable moat, and at the same time we may see domestic and international market expanding to 221 million airline passengers in FY24 to 370 million by FY30, and that is why they are being a little bullish on Indigo. Apart from that, let's look at some of the brokerages on the earnings. So for example, on ICICI Bank, Nomura has now maintained buy rating and hiked the target price to 1,335 rupees because we have seen a strong set of numbers coming up from this bank. Let's now talk about HCL Tech, because now Nomura has maintained neutral rating while cut the target price to 1,400 rupees per share, because what they believe is that in 4Q we have seen mixed bag of numbers, and at the same time guidance for FY25 were weak. At the same time, if you look at Investec, now they have also maintained sell rating for HCL Tech and maintained a target price of 1,300 rupees per share, because they believe again that revenue guidance were actually weak from the company. Let's now talk about Tech Mahindra, because Morgan Stanley has actually upgraded the rating to overweight from underweight rating earlier, and also hiked the target price to 1,490 rupees, because they saw that Q4 numbers were actually in line with what they were expecting, and at the same time management's tangibles and quantifiable outlook for FY27 makes actually them a little reliable on the company, and that is why they are being a little bullish on this company. Next, let's talk about Shriram Finance, where Goldman Sachs maintained buy rating and hiked the target price to 2,864 rupees after a strong set of numbers, and at the same time Jefferies also increased the target price to 2,950 rupees while maintaining buy rating because of the Q4 results that we saw. And lastly, let's talk about Maruti, because Jefferies has now maintained buy rating and hiked the target price to 14,750 rupees per share because of the good growth that we have seen. We saw that EBITDA was actually a little missed because of a few reasons, but Jefferies believes that hybrid tax cut can actually provide upside for the company from here on. And at the same time, UBS has also maintained buy rating with a target price of 14,000 rupees per share, because they said that margin miss was actually not a concern. Demand has remained steady for the company. So all in all, on the back of brokerages, we will definitely watch out for these companies as well.
Alright, Gaurav, thanks so much for taking us through that. But well, another Nifty 50 company slated to report its numbers today is UltraTech Cement. And what will be the impact of declining cement prices on the company's Q4 numbers? Ashesha is joining in what the street is penciling and what we can expect. Ashesha, good morning. Take it away.
Well, yes, we are expecting mixed set of numbers from cement major UltraTech Cement, which will be reporting its numbers later today. Volume growth is expected to be strong this time around on a sequential basis, but lower cement prices are expected to impact spreads for UltraTech Cement this time around. Remember, cement prices declined nearly 5 to 6% on a sequential basis, and that is expected to impact both realizations as well as EBITDA per ton. As far as numbers are concerned, consolidated revenues could come in at about 20,400 crores, which will be an uptick of 22% on a sequential basis. Margins, meanwhile, are expected at 18.4% versus 19.4% that the company had reported in the previous quarter. As I mentioned, volume growth is expected to be strong. EBITDA per ton is expected to decline 8 to 10% on a sequential basis, and we are expecting EBITDA per ton to come in at 1,050 rupees per ton. Variable costs and operating costs are expected to fall by 2 to 4% on a sequential basis. In terms of management commentary to watch out for, any commentary with respect to cement prices trend going forward, with respect to input prices and capex plans going forward will also be crucial. But all in all, mixed set of numbers expected. Volumes are expected to be strong, but spreads, EBITDA per ton and realizations are expected to decline on a sequential basis.
Alright then, thanks Ashesha. So of course UltraTech Cement will remain in focus throughout the trading session today, but with that we're timed out on this edition of Market Cafe on ET Now. From me, Shreyanshi Singh, Snehi Shah, as well as the entire team that put this show together, thank you so much for tuning in. You don't go anywhere because the market takes all of the action forward.